We've spent the last few years watching AI conquer our screens and generate text, but right now it is stepping out of the digital world and taking physical form in the real world. According to Nvidia CEO Jensen Huang, the ChatGPT moment for general robotics is just around the corner. This deployment is already happening at a massive industrial scale. Back in 2019, Amazon had 200,000 robots in their facilities. Fast forward to 2025, and they have over 1 million robots working on their warehouse floors. The consumer side is scaling rapidly too. Waymo's driverless vehicles grew from 10,000 rides a week to 450,000 rides a week in just 2.5 years, a massive 45x multiplier. Physical AI is an active, rapidly deploying infrastructure right now. This sudden growth is triggering intense FOMO, the fear of missing out, among retail investors looking to capture the hardware wave. But chasing that excitement carries serious financial risk. This chart shows the harsh reality of the robotics industry. On the left side, we see an exponential upward curve measuring the sheer number of robots being deployed. But on the right side, the profit margins for U.S. robotics manufacturing hover stubbornly below zero. Software is incredibly cheap to copy and distribute. Building physical hardware requires massive factories, expensive raw materials, and complicated global supply chains, creating a deep cost chasm. China bridges this profitability gap directly through their government. They pump huge sums of money into their domestic robotics companies, keeping them financially afloat while they establish dominance in the global market. To aggressively compete, the U.S. government is now preparing billions of dollars in domestic subsidies and military investments to support American robotics development. This creates a brutal dilemma for you as an investor. You know the sector will expand, but attempting to pick a single winning robotics startup means taking on an extremely high risk of bankruptcy if that specific company runs out of cash. To capture the upside of this macro trend without risking a total portfolio wipeout, investors need to abandon individual stock picking. The practical alternative is using targeted ETFs. An ETF, or exchange-traded fund, is a basket of different stocks sold as a single package, allowing you to spread your risk across dozens of companies at once. This chart maps your ETF options. The vertical axis measures direct exposure to robotics. The horizontal axis measures risk and volatility. Strategy 1 is the broad pure play, using funds like bots and robo. We place this in the top right quadrant: maximum exposure, maximum risk. These funds cast a wide net, giving you exposure to 50 to 70 different companies that are actively building complex physical robots and automation systems. The trade-off is severe. Because the sector is largely pre-profit, buying these ETFs guarantees a highly volatile ride. You are mathematically guaranteed to see some of the companies inside this basket go completely bankrupt. The pure play strategy offers uncapped upside, but it functions much more like a speculative venture capital bet. You have to be willing to stomach deep drawdowns to see the potential gains. The second strategy involves following federal money. Billions of dollars are currently flowing directly into autonomous military technology and defense research. Defense ETFs, such as ITA and PPA, act as a backdoor method to invest in the robotics companies securing these massive, reliable government contracts. When we plot defense ETFs on our chart, they sit lower on the risk axis than the pure play node, but they also offer lower direct exposure to the commercial robotics sector. The trade-off here is geopolitical. You gain the financial stability of companies backed by federal tax dollars, but their revenue relies heavily on defense budgets and global tensions. Defense ETFs function as a geopolitical hedge. They provide a heavily subsidized floor to your robotics investments, but you sacrifice the explosive upside of the broader consumer and commercial markets. Strategy 3 focuses on the reshoring trend. Bringing manufacturing back to the United States requires heavy automation to offset the higher costs of domestic labor. Traditional industrial ETFs like XLI allow you to invest in the massive legacy companies that are adopting this robotics technology to run their factories and lower their overhead. We map manufacturing ETFs in the bottom left quadrant. They are low risk, but offer the lowest direct exposure to the robotics tech itself. The major drawback is dilution. Robotics is just a tiny fraction of what these legacy corporations actually do. The impact of their factory automation is heavily diluted by the sheer size of their other operations. While this is the safest harbor from tech sector volatility, that heavy dilution severely caps your upside. It's a stable play, but a weak strategy if you want to capture the true growth of a robotics boom. The fourth strategy relies on a picks and shovels philosophy. Instead of guessing which specific robot brand wins the market, you invest in the foundational technology that every single robot requires to function. First, every robot needs a physical computing brain, requiring semiconductors. These are the microscopic chips acting as the hardware inside all modern electronic devices. Second, every robot requires massive amounts of cloud storage to train and run its AI models, which drives demand for physical data centers. Infrastructure ETFs like SOXX and DTCR sit high on the vertical axis for overall exposure and land right in the middle for risk. The core trade-off is the entry price. Because of the massive software AI boom we saw in 2023, these assets are already priced very high, meaning you have to pay a premium to enter the market right now. However, infrastructure ETFs let you profit off the mathematical certainty of the industry's growth. You completely bypass the gamble of predicting which startup builds the best robot, and instead own the technological toll road they all have to drive on. The reality of the robotics transition comes down to this. Despite what you see on social media, there is no safe, guaranteed way to get rich quick on physical AI. This is a decision tree you can use to map these ETF strategies to your specific risk tolerance and financial goals. If your primary goal is capital preservation, or you are near retirement, you should avoid direct exposure to this sector entirely. The timeline to profitability is too long. Use broad S&P index funds instead. If you have a 5 to 10-year time horizon and want maximum upside, the pure play ETFs are your target, assuming you can endure massive drops in value along the way. And if you are a pragmatic optimizer looking to bet on the overall macro trend without picking specific brands, the AI infrastructure ETFs offer the most reliable path. Do not let internet hype dictate your portfolio. Weigh the hard data, respect the difficulty of hardware manufacturing, and choose the specific ETF vehicle that is calibrated to your exact financial reality.